So, what is going on with the 2026 housing market? It's sending some seriously mixed signals. On one hand, you see all these signs that things are starting to heat up again. But on the other, there are these huge risks that could just stop the whole thing in its tracks. Today, let's try to decode what's really happening.
So that's the big question, right? Is the market finally recovering for real? Or is this all just a false start before it gets cold feet? There's actually a pretty compelling case for both sides of that argument. But let's start with the good news, the case for optimism.
And honestly, the case for growth is surprisingly strong. It's really built on three key indicators that are all pointing in the right direction. So let's dive in, starting with the most direct one, actual home sales.
After that typical slump we saw over the holidays and through the winter, existing home sales are on the rise again. In fact, if you look at the end of 2025, sales actually closed at a 9-month high. That tells us that buyer demand is really shaking off the winter chill and seems poised for some real growth this year. And get this isn't just some one-time fluke. Home purchase applications have actually grown year over year every single week of 2026. The latest data we have shows an 11% jump. That is a really powerful signal that buyers are consistently coming back into the market. And to round out our little trio of good news here, we have pending sales. Now, this is a huge forward-looking indicator, and in the last few weeks, especially now that all that bad weather is behind us, the data has been consistently positive. So when you look at it all together, all three major demand indicators are flashing green. This positive momentum isn't just for sellers either. Buyers are finally getting some much-needed relief. Housing inventory is finally starting to recover from those crazy lows we saw after the pandemic, and that's helping to cool down that rapid-fire price growth and create a market that's, well, a little more balanced for everybody.
And you knew there was a but coming, right? It's a very, very big one. All of this positive momentum we've just walked through, it's incredibly fragile. It all comes down to one single overriding factor that could change everything in an instant.
This quote just says it all, doesn't it? Forget all the other noise for a second. At its core, the story of the housing market for the past few years has been a story about one thing: mortgage rates. They are the key. They can either unlock all this growth we're seeing, or they can stop the market dead in its tracks.
And that brings us to maybe the most important number in this entire explainer, 6.25%. Think of it as a kind of magic number, or maybe a ceiling for the market. As long as mortgage rates can stay below this level, the recovery we're seeing actually has a fighting chance.
And we're not just talking about some abstract concept here. The stakes are incredibly high. If rates do manage to stay below that 6.25% threshold, it could translate into an additional 237,000 home sales this year compared to last. That is a huge, tangible impact. So this one single factor creates two totally different futures for the housing market. Look at this. On the left, with those low rates, we get a clear path to continued growth. But on the right, if rates spike up towards 7%, the picture turns bleak almost instantly. The recovery stalls. The choice between these two paths really is that stark. Okay, so if low rates are the hero of our story, what are the villains? What external forces could come along and push rates higher and just spoil this whole potential recovery? Well, unfortunately, there are a few pretty significant storm clouds gathering right now. We can really see four main threats on the horizon. First, you've got global conflict pushing up oil prices, and that just fuels inflation. Second, you have officials at the Federal Reserve, people often call them hawks, who are worried that inflation is still just too high, and they might push for policies that raise rates. And their concern is being fueled by inflation data showing prices are still stubborn. And then finally, there's the threat of new trade tariffs, which could also push prices up, forcing rates higher to compensate. So, with all these competing forces, all this good news, all this bad news, it all comes back down to mortgage rates. If you want to know where the housing market is truly headed, what are the key signals you should be watching? All right, here are the two numbers to watch. First, the 10-year Treasury yield. Think of it as the base rate, the foundation that a lot of lending, including mortgages, is built on. Second, keep an eye on what's called the mortgage spread. That's just the extra amount lenders add on top of that base rate. Both of these have been pretty low, and that's what's kept mortgages affordable. If either one of them starts to creep up, that's a major warning sign for housing. Which leaves us right here. The housing market is on this very, very narrow path. It's like an economic tightrope. On one side, you have all this growth fueled by pent-up demand.
But on the other, you have a stall caused by global inflation and geopolitical risk. Can it maintain its balance? That is the big question for 2026, and now you know exactly what to watch for. Thanks for joining me.